In today's video, I'm going to talk about how inflation leads to higher taxes. Hey folks, I'm best-selling author David McKnight. Today we're going to be talking about how inflation could cause you to pay more in taxes. Okay, it's no newsflash that inflation is hitting just about every facet of our lives these days. Inflation over the last 12 months through April 2022 is 8.3%, according to U.S. Labor Department data published on May 11th. Now, the common reaction to the question of whether inflation means more taxes is to simply say, well, the IRS historically has been pretty good about indexing tax brackets to keep up with inflation. So assuming that wages keep pace with inflation, you should remain in the same tax bracket over time. While this is generally true, there are a number of thresholds in the IRS's tax code that aren't indexed to keep up with inflation and could result in you paying higher taxes. The first area is Social Security. We know that if as a single filer your provisional income exceeds $34,000, or if as a married couple your provisional income exceeds $44,000, then up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. Inflation poses a couple of problems for this scenario. First, these provisional income thresholds have not been adjusted to keep up with inflation in the last 30 years. And so far as I can see, no one has proposed indexing the provisional income thresholds to inflation. Second, half of your Social Security counts as provisional income. So as your Social Security rises to keep pace with inflation, you get pushed ever closer to the provisional income thresholds. Well, that's not a big deal if inflation increases at the historical rate of 3%. However, that's not what we actually see happening. Initial projections show that Social Security will increase by 8% or so in 2023, and most experts believe that this wave of inflation is not, in fact, transitory. So we could see these types of increases in Social Security for the foreseeable future. So in the coming years, you could be propelled towards the thresholds, at which point your Social Security gets taxed at ever-increasing speeds. Let me show you how this could affect you in practical terms. So let's say that in 2022, your Social Security is $40,000. That means that half of that, or $20,000, will count as provisional income. Well, if your Social Security goes up by 8% in 2023, that means you'll be receiving $43,200 of Social Security. Half of that, or $21,600, would count count as provisional income. And when coupled with your other sources of provisional income, like your RMDs or 1099s from your taxable bucket, then it increases the likelihood that you'll breach the thresholds that can cause Social Security taxation. The next area where inflation could cause you to pay more in taxes is when you sell your primary residence. We know that as a single filer, any profits up to $250,000 that result from the sale of a primary residence are tax-free. That number goes up to $500,000 as a married couple. The problem is this number hasn't been adjusted for inflation since 1997. So if the value of your house rises to keep pace with inflation and then you sell it, you have a higher likelihood of the growth on that house being subject to capital gains tax. This is, of course, what we call a phased-in tax increase. It's a politician's way of raising your taxes without the political baggage that goes along with actually raising your taxes. It allows politicians to put the blame on inflation, which ostensibly is beyond their control, versus instituting an actual tax increase, which can have massive political consequences. Pretty sneaky. Another area where inflation can hammer you is through the Obamacare surcharge that we discussed a few videos ago. If you recall, the Obamacare surcharge of 3.8% is levied on any investment income greater than $200,000 as a single filer or $250,000 as a married filer. And these thresholds have not historically been indexed to keep up with inflation. So as your earned income and your investment income rise over time due to inflation, it can push you much closer to the thresholds where your investment income could be charged that extra 3.8%. Keep in mind, the sale of a primary residence that we discussed earlier counts towards these thresholds. So in a sense, inflation could force you to pay a double tax on the sale of a home. The first one for the actual capital gain, and a second one for the Obamacare surcharge on that gain. Next, the $10,000 limit on the federal deduction for the so-called SALT or state and local taxes hasn't changed since 2018. So when your income goes up, then your state and local taxes rise commensurately, and a smaller and smaller percentage of that is deductible on your federal tax return. Once again, thanks a lot, inflation. Lastly, we need to talk about state taxes. According to taxfoundation.org, quote, 41 states and the District of Columbia tax wage income, while New Hampshire taxes just income and dividend income. Of these, 15 states and DC fail to adjust brackets for inflation. 10 states leave their standard deduction, if they have one, unadjusted, and 18 have an unindexed personal exemption. Taken together, 22 states and the District of Columbia have at least one major unindexed provision. 13 states fail to index any relevant major component. In some cases, they may forego a standard deduction or personal exemption, but all relevant provisions are unindexed. They are Alabama, Connecticut, Delaware, Georgia, Hawaii, Kansas, Louisiana, Mississippi, New Jersey, New York, Oklahoma, Virginia, and West Virginia, close quote. So if you live in one of these states, you'll be exposed to what we call bracket creep. This is what happens when tax brackets fail to adjust for changes in consumer purchasing power due to inflation. That hasn't historically happened at the federal level, but as I've shown, many states just don't seem to care. They can increase their revenue without having to impose an actual tax increase. Your taxes will increase with the simple passage of time. Okay, it's time for today's Power of Zero question of the day. Do you think inflation is transitory, or do you think it's here to stay? Go ahead and put your answers in the comment section below. Lastly, I'd like to discuss the impact of modern monetary theory on higher taxes. Remember, advocates of modern monetary theory believe that printing money is a reasonable way to pay for government initiatives instead of making the politically dangerous decisions like raising taxes. Well, as I warn in the author's note of my upcoming novel, The Infinity Code, as the federal government spends their way into oblivion under the classical economic approach, tax rates would have to rise dramatically to keep our country solvent. Debt rises, and as interest rates return to historically normal levels, the cost of servicing the national debt will eventually consume the entire federal budget. There won't be any money left to pay for entitlements, military, welfare, food stamps, or the cost of running the federal government. And this could precipitate a doubling of tax rates within the next 10 years. What few people realize, however, is that the adoption of modern monetary theory would also precipitate a dramatic rise in tax rates. MMT theorists believe the government can issue unlimited amounts of debt to pay for a broad range of spending initiatives and simply print more money to pay the interest on that debt. When we print more money to pay debt interest, however, it undermines investors' confidence in our ability to repay that debt. As their confidence begins to wane, they will demand higher interest payments in return. That will, in turn, drive up the cost of servicing our national debt. As this vicious MMT-driven debt cycle comes to a head, we'll eventually be forced to return to the classical economic approach to find solutions. At that point, the government will be forced to raise more revenue to pay our exploding debt interest in the traditional way by raising taxes. So regardless of whether we adopt the classical economic approach to solving our economic problems or modern monetary theory, we'll all be facing dramatically higher tax rates in the near future. This spells trouble for you if you have the lion's share of your retirement savings in tax-deferred vehicles like 401ks and IRAs. In summary, it's easy to believe that there is no relationship between higher taxes and inflation. After all, the IRS has always indexed federal tax brackets to keep up with inflation. As inflation rises, your federal income tax brackets rise commensurately. However, there are a number of thresholds in the U.S. tax code and also state tax codes that do not index for inflation. So as inflation rises, you will, as a matter of course, be exposed to more taxes over time. Of course, the best way to shield you against all of these taxes is to simply get to a 0% tax bracket in retirement. Why? If the lion's share of your income in retirement comes from truly tax-free vehicles like Roth 401ks, Roth IRAs, LIRPs, etc., then you won't be exposed to any of the tax that we've discussed today, with perhaps the possible exception of a capital gains tax when selling your home. If you need some help navigating these types of strategies, head on over to davidmcknight.com and opt in for a complimentary strategy session. I'm happy to give you a hand. Don't forget to click like, subscribe, and the bell so you never miss a video. And feel free to make comments or ask questions in the comments section below. This is David McKnight. I look forward to seeing you on the next video.